Welcome to this week's edition of IG Trading the Markets podcast. It's now almost 8 weeks since we went into the government-driven lockdown. What's changed? Let's catch up now with BCA Research Chief European Strategist Dhaval Joshi. Dhaval, welcome. We spoke just as we were going into the recent period of working from home. It's time now to catch up again on where we are. As someone that looks at the mechanics of the markets over these 2 months, what's changed in your mind?
Well, I think that the obvious thing that's changed is that markets are significantly higher. So they have sort of bounced maybe 15%, 20% in some cases from the lows that we saw in the middle of March. So that's the most obvious change. And it's a little bit of a paradox because on the one hand, we're being told, and we're actually seeing, that we are in one of the worst economic downturns since the Great Depression. We're talking about double-digit percentage contractions in GDP. Unemployment rates are surging. Unemployment's running at 15% in the US. And yet the markets have seemed to have shaken this off. And looking at just the level of the market and the performance, you'd kind of say, well, look, they seem to be relatively unconcerned that we are in this very, very severe downturn. And that, in a sense, is a big question. Why are markets shaking off what is clearly a very weak economy?
Could I put it to you that perhaps maybe the markets are focusing maybe too much on all this government and central bank stimulus that we've had? Clearly, there's a lot of money going into the markets from the authorities. And this presumably is having some sort of supportive effect to the markets. And it's being felt, as you said, in that rally that we've seen in equity markets, whatever it's now pricing in. Will all this stimulus ultimately, though, when it really boils down to what it means, really make that much of a difference? We've got to remind ourselves, of course, that going into this downturn, it was a natural phenomenon. It wasn't an economic downturn driven by issues around the global economics as were 8, 10, 12 weeks ago. It's all about the lockdown because of COVID. I mean, COVID may well come back. Doesn't matter how much money you throw at the markets. How should we address the future moves in the markets on that basis?
So there's two ways of looking at this. If you're a very long-term investor, by which I mean with a multi-year horizon, the most important thing that will have happened to you is that the bond yield has collapsed in the last few weeks, last few months. So as a long-term investor, you're being offered this pitiful yield on bonds. In some cases, it's actually negative. And therefore, for you, as a long-term investor, you're saying, well, look, I'm getting nothing on bonds, or even getting negative return on bonds. And therefore, I'm prepared to buy equities at very high valuations. In other words, I'm going to accept a very, very low return on equities as well, which of course means that the price today has to go up, the valuation goes up. So as a long-term investor, you're behaving quite rationally, because you're saying, well, COVID is an issue right now. It could be an issue for the next 6 months, maybe even, it could go on for a year. But if I'm thinking beyond that, say 2, 3, 5 years ahead, then for me, the most important thing is that I'm getting nothing on any other asset class at the moment, and therefore I'm prepared to pay a much higher price for equities. Now, the other way of looking at it is from a short-term investor's perspective. And again, what the short-term investor is saying, as per your comment, is, look, this is a man-made recession. It's caused by governments shutting down economies. So if they can shut down economies, they can reopen them as well at some point quite soon, in which case this is only a sort of 2-quarter setback, and we should be sort of back to normality within 6 months or so. That's the sort of more risky assumption to make. I think the long-term investor is probably correct. The short-term investor who's expecting, business as normal, or, business as it was within a few months, that's the time horizon that could be disappointed. So a lot of businesses will not return to normal. I think that's the risk. If you're an investor with a 6-month, 1-year horizon, you could be disappointed when things do not return to normal.
So do you subscribe to the analysts that I've seen comment on this recent market move up in the equity markets, that we could well now be in for a period of downside before the markets rise again? Do you think that is the case, or do you think we'll end up holding on to the gains that we've seen in the equity markets on the basis that there's a long-term advantage in holding these? Or is there this risk, do you think, that we could see another 20, 25% downside before the markets start to recover again?
Well, I would say that in terms of if you're trading the market, if you're a short-term horizon investor, I think a lot of the easy money has been made in that rally from, whatever it was, 2,200 on the S&P up to sort of 2,900. That's a pretty sharp technical rally. So I think that's the easy money made. And I think we're in a period now where, markets could consolidate. They could be sort of range bound for some time. And I think there is also a risk of a new setback. If it turns out that this sort of first wave of infections hasn't ended, it might have ended in London or New York, but it's just moved to other cities. It's moved, for example, to Russia. That Russia is the new hotspot. Other cities in the US may see flare-ups of the first wave, and also there's a possibility of a second wave in economies that reopen too soon. So we've seen, potential second waves in South Korea, Japan. Even in China, there's a risk of second waves in Wuhan and other cities. So those are the risks from a COVID perspective. But there's also other risks out there. I mean, don't forget that we got the presidential election not that far off now. It's only 6 months away, less than 6 months away. Then we also have renewed tensions between the US and China. We have tensions in the euro area. So these risks are still lurking below the surface. So what I'm really saying is if you're a long-term investor, you're not worried about marking to market, you don't care about the journey, and you're only concerned about what your portfolio is going to look like in 2 years' time and beyond, then I'm happy to advise, yes, you can stay in the market. But if you are a trader who marks to market, so to speak, more regularly, I think we're entering a more risky phase for the equity market now.
Let's pick up on that point you mentioned about bond yields. One of your papers, I think it was last week, you issued, you identified that Europe is not as advanced as the US and China in terms of the controlling the deceleration of bond yields. What's going on in the bond markets at the moment? And is your point behind this the fact that Europe is in a more fragile state than the US and China? Is that the correct interpretation?
Yes, I mean, in the sense that bond yields and interest rates already pretty much at the lower bound or very close to the lower bound. So I think the absolute lower bound in interest rates is around -1%. Anything below that, and the risk is that the banking system just completely blows up, because once you start lowering interest rates below -1%, then people just take their money out of the banking system, assuming the banks are passing on these negative rates, and the whole banking model collapses. And this is one of the reasons why, given that Europe's already close to this lower bound with negative rates already, it's very difficult to apply monetary stimulus. And we're seeing that in the credit numbers. We're just not seeing any major pickup in bank credit in Europe compared to what we're seeing in the United States and in China. And the simple reason there is in the US, the bond yield has come down much more than it has in Europe, because it can come down because you're much further from this lower bound. And China even more so. So I guess what I'm saying is that if you are going to invest in bonds, there is no point really investing in European bonds, because yields are already down as far as they can go. So, for example, in Switzerland, you're at sort of close to -1%. But in the US and China and in Australia, let's say, yields could come down further if the central banks wanted them to come down. If you are going to have bonds, have them in the US, Australia, and if you can invest in China, in Chinese bonds, although that's a more difficult investment because you need to have a Chinese account before you can invest in Chinese bonds. But that to me is a very attractive investment if you can do it.
Okay, let's just round this off with one final question. I spoke about the amount of money that the authorities and central banks and so forth are pumping into the economy. We heard recently here in the UK, of course, the extension of the furlough scheme. We now know a little bit more about how much that's going to cost the British government, us as the taxpayer. We're hearing replications of this model across the US, across Europe, and further afield. Is the money, apart from those that are receiving it, let's say under furlough, what about the money that's been pumped into the markets through the quantitative easing that we've seen? Is it getting through to the right areas, do you think, of the economy in order to make a difference?
My assessment is it's relative to the plunge in income. The stimulus is the stimulus sounds like it's massive, and it is by any sort of historical context, it is a very large stimulus. But bear in mind that a massive chunk of the economy has just stopped working. So, if we see, for example, a quarter of the economy just stops working, then obviously we're going to have a 25% contraction in output. So even if a quarter of the economy halves, that's a 12.5% contraction in GDP. So the stimulus sounds like a lot, but if this shutdown is extended or it has to be repeated because there's a second wave, then the stimulus, all it's going to do is fill a big hole in the economy caused by the economy shutting down. So what I'm saying is put the stimulus in the context of the magnitude of the loss of output. If it's a very short and temporary loss of output, then I think the stimulus is going to be effective, because people are going to say, look, it's business as normal, interest rates are much lower, we've got all this credit available to us. That's a sort of potentially good outcome. But if economies, stutter and they do not get back to sort of normality for some time, then the stimulus is just simply a sort of palliative rather than an actual cure to this economic setback.
Okay, Darvel, thanks indeed. We'll leave it there, but thanks indeed for joining us. That was BCA Research Chief European Strategist, Darvel Joshi, with today's IG Trading the Markets podcast.